It's Wednesday, July 21st, 2010. Welcome to freetradingvideos.com. D7 here. And the market spooked by Mr. Ben Bernanke. He's president, chief, if you will, over the FOMC, coming out telling that the Fed will step in and is ready to step in if the economy takes another dip to the downside. And he says that any sort of recovery is, quote, unusually uncertain, end quote. And so that will spook investors for sure, having that sort of talk coming from him. But I think he's just being very frank, and he's a realist, and that is where we're at here in the economy. Some other stressful news: European banks, they're saying now that their income for last quarter could be down as much as 40%. Ouch. So anyway, we have crude down more than 1.3% and gold down 0.5%. But check this out, gang. Wow, financial stocks. The market's only as strong as financial stocks. Giving it support. Financial stocks took a 2% hit today. 2%. Well, that is relative to what's happening actually in the broad markets. So we have the financial stocks actually doing worse than what we have, and that is Matador calling me, and I will have to ignore his call for the time being. But anyway, the Dow is down 1.07%, the S&P down 1.28%, 1.3%. We have 1.6% drop here on the NASDAQ. The Russell's down 1.65%, and the VIX popping. Look at this, a 7% pop. 25.6. The volatility has increased. That's the fear indicator popping up nicely there. The ES, which is the S&P future E-mini contract, is down 1.5% after hours. At the time I'm doing this is 4:15 Eastern Standard Time. So the markets continue to sell off even after post market. But here we are looking at the S&P daily. The S&P daily, we remain in a down channel, and this down channel is a down trend. We're at a resistance area. But let's blow this up ever so slightly and really take a look at this. And that was him leaving me a message. Yesterday, check this out. Yesterday, Matador came on and did a video for me, which I so appreciate. But we had a major pop. Look at this. We made a higher high, but we also made a lower low. So we kind of have what's called an engulfing type pattern, finding support at the 20-day moving average. We rallied high and then closed. Right at the end of the day, a major pop. Now today, Wednesday, we gap up. Where do we gap to? The 50-day moving average. The 50-day moving average acted as resistance. We went up a little bit, tagging this upper trend line that we have. And then we sold off just the remainder of the day. It was a little bitty pop at the end of the day, closing us above the 20-day moving average. The 20-day acted as really nice support, and the 50-day acted as really nice resistance. Very seldom do you see this, but anytime you start to see candlesticks getting pinched between the 20 and the 50-day, like we are starting to see right now, those can produce some nice moves to the upside or the downside. Stocks hate to be pinched. We have moving averages starting to pinch the price action, so I'm looking for a move one direction or the other. Now, if the 20-day and the 50-day continue to act as a support and resistance area, and the price action continues to build sideways, we will have a bullish pennant formation built off of an up leg. Bullish pennants are more bullish than bearish, and I'd be expecting a pop to the upside. If in fact we were to get that formation and we were to get that confirmation, I'd be looking to go bullish, but I would be a bull with my stop losses in place. I would certainly want to be protected in that event. The other thing we'd have is an inverted head and shoulders. Shoulder, head, and shoulder. Inverted head and shoulder trend reversal pop is only confirmed if the neckline gets popped, and in this case that would have been the case. So certainly there'd be more room to the upside than the downside, but just right at this moment we're at a real crucial area because we are in a downtrend at resistance area with little to stop us to the downside. Any support I see at 150, and then my next area of support is 1023, and then after that we're looking at about 1000, which is this trend line. So that's what we're looking for. The MACD right now remains above the 0 line, and even though we have a negative histogram tick, we still remain above 0, so that remains bullish. So that's where we're at. So quit thinking like amateurs, start thinking like professionals. You want to be trading knowing what you see. When you look at a chart, you need to understand what patterns are before you so you can take advantage of those patterns once you see them and recognize them. You have to go a step further than that. Now you have to have significant rules in place so you can put those rules on top of those patterns, and those rule sets have to be rule sets that increase your probabilities in trading. So I'm on a soapbox here, but you have to have the right skill sets or the right rules to place on top of these patterns that you see. So you need to, one, recognize the patterns, two, have rule sets to put on top of those patterns, and then play it, pull the trigger. If you have a confluence of buy signals, don't hesitate, pull the trigger, get in there and start making money. Studies show 89% of all traders don't just lose money, but they blow through 100% of their trading capital. That leaves roughly 11%. So the NASAA says roughly 11% of all retail traders can make consistent profits out there in the markets. Well, it's because the average trader out there is not disciplined and don't have the right skill sets, and certainly don't have the right trading education to be able to make trading consistently profitable. So anyway, what I'm saying here is education is where it's at. Make sure that you get the very best of education, and to be quite frank, you're at the very best place. You're at the best place possible to get the richest and the best of trading education. So stay close and stay trading.